Welcome back to the Wealth Hub IQ. Today, we're diving into an incredibly important topic that affects everyone: retirement planning. Whether you're just starting your career or already thinking about retirement, it's crucial to have a solid plan in place to secure your financial future. In this video, we'll explore the key steps you need to take, share some eye opening statistics, and offer practical advice to help you on your journey. Retirement may seem far off, but the sooner you start planning, the better off you'll be. According to the Employee Benefit Research Institute, only about 42% of Americans have tried to calculate how much money they will have to save for retirement. Let's change that today by breaking down the essentials of retirement planning. Number one, start saving early. The first tip is to start saving as early as possible. The power of compounding interest can't be overstated. The earlier you start, the more your money will grow over time. According to Investopedia, if you start saving $200 a month at age 25 years old, you will have around $500,000 by the time you're 65 years old, assuming a 6% annual return. If you start at 35 years old, you will have only about $250,000. So you can see the difference here. From a 10-year age gap of 25 to 35, if you start investing earlier at the age 25, you double the amount of compounding interest you're able to accumulate with a 6% annual return at £200 a month. So if you're able to deposit £200 a month at the age of 25, then you can receive $500,000. And if it's at 35, 10 years later, it's only $250,000. So you can see the disparity there. So start early. So with this example I used the example of $200 a month. However, that is case by case. You could set up something that's specific to you or personal to you. The point that I'm trying to make here is invest earlier rather than later. So even if you can only save a small amount each month, start now. Consider automating your savings to ensure consistency. So you can go online, and this is what I did. I went online and I searched retirement savings accounts that I can acquire through stocks and shares. So is there any stocks and shares I saw that give me a tax advantage of holding money on a monthly basis in them specifically, so that when I reach retirement age, I'm able to withdraw this money and have a tax incentive to do so as well. So there's multiple places you can go on online. Just search in retirement stocks and shares and a bunch of options will come up for you. And from there, it's very, very important to either do your own research and also to accompany that by speaking to a specific accountant or a financial advisor. Number two, take advantage of employer-sponsored plans. Many employers offer retirement plans like 401ks or pension sacrifice in the UK, often with matching contributions, meaning if you put up 5% of your salary, they would also match the monetary figure and put up however much 5% is of your salary. They will then match that amount. So you're timesing it by 2. So instead of you putting up 10%, you would put up 5%, the company will put the other 5% as well, and then that would equate to 10% of your salary, but you're only paying for 5%. Not taking full advantage of this benefit is like leaving free money on the table. We do not want to do that, guys. According to the Bureau of Labor Statistics, about 51% of workers participate in a workplace retirement plan. This is an awful statistic because, as I just said above, they're literally giving away their own free money that they could be using towards their retirement plan, towards their pension. So instead, what we want to do is we want to contribute enough to get the full employer's match if available. This is essentially a guaranteed return on your investment. So imagine you're able to put 20% of your salary. And remember, this is very case by case. So if you cannot afford to do this, then don't do this. But make sure you're able to assess this with a financial advisor. But what a lot of people do is they go and acquire the maximum amount that their employer will match, for example, 20%. And then when they put 20% of their own salary, their company would put 20% as well. And then that's 40% of your salary going towards your pension in the future, almost 50%. But that's 40% of your salary going towards your future. And you can imagine the compounding returns on that. Point 3, diversify your investments. Diversification helps manage risk and can improve your chances of a successful retirement. The whole point of diversifying is to not put all your eggs in one basket, meaning that if you put all of your eggs into one basket and one egg fails, then the chances are that one egg may affect all the other eggs in that same basket. However, if you put your egg in separate baskets, even if one egg was to smash or fail, then the other eggs in the other baskets are protected, and that's how you should treat your investments. A Vanguard study found that a diversified portfolio can potentially reduce risk by about 50% compared to a non-diversified portfolio. So as a practical advice here, I'd say consider a mix of stocks, bonds, and other assets. Use target date funds if you're unsure how to balance your investments. And under other assets, I mean things like property, things like NFTs, things like even artwork painting. If you can buy a catalog of someone and own royalties, also your job is considered an asset as well. So have a mixture of all of these different things. So I'll use an example of a good friend of mine. I know this particular friend used to work a 9-to-5 job, and that was their sole income. They specifically relied on this one income. And during COVID-19, this person actually lost their job. And as they lost their job, they had no savings and they had no other investments which were bringing them cash flow. So as a result, what happened is this person realized the importance of diversifying their income. What did this person do? Well, they started leveraging their skills that they earned during their time as a 9-to-5er, and then use that to contract. As they were contracting on freelance websites such as Fiverr and Upwork, they realized the importance of continuing to diversify their portfolio. So as this person was still looking for a permanent job, they then also, with the money that they acquired from freelancing, they started to invest in the stock market. And that same person started looking at properties as well. So now they've got their money in freelancing work, in stocks and shares, and also in properties. And I think this person's also looking to look into NFTs as well. So you can see that they're trying to spread their risk out so that if something like this was to happen again in one of their assets or one of their investments, they'll be in a much better place to handle the situation. Remember, anything can happen tomorrow, and you may have children, you may have family members that depend on you, you may have an upcoming wedding, you may have so many financial responsibilities that are always on your back. So you want to make sure that you're in a situation where you can handle that even in the worst time. Point number 4, understanding social security benefits, or if you're in the UK, that's just benefits. Social security is a key component of retirement income for many people, but it's important to understand how it works and what you can expect. The Social Security Administration report that social security benefits represent about 33% of the income of the elderly. This is a United States statistic. So what exactly am I trying to say in this? Well, I'm trying to say that understand how much you're going to be eligible for as soon as you hit retirement, and then also understand your lifestyle. When you reach at retirement age, would you like to travel more? Would you rather stay at home much more? Are you a fancy person? Do you like buying things and shopping in higher end places? Would you prefer the calmer life? Assess your situation, assess how much you're gonna be earning from the government, and also realize how much you've saved thus far, and try and come up with a calculator of how long you can continue to run on that money. Remember as well, if you're approaching retirement, you may want to pass on or give money to grandchildren or children for their future as well. So also look at something called a trust fund, where you're able to wrap your money up in a trust fund, but I'll speak more about that in a separate video. I strongly advise you to visit the Social Security website to get an estimate of your benefits, or if you're in the UK, visit www.gov.uk to understand what your benefits are, your retirement benefits is once you reach that age. Point number 5, manage debt wisely. Entering retirement with high levels of debt can strain your finances. Aim to pay off significant amount of debt before retiring to give yourself less stress and hassle. The Federal Reserve notes that the average debt for a household led by someone 65 years old or older was $31,300 in 2019. So as a practical advice here, we say create a debt retirement plan. Focus on paying off high interest debts first and avoid taking out new debt as you approach retirement. Debt management is definitely something that you have to consider right from the beginning of your retirement and even before retirement, so that you can make sure that you feel like you don't have to go and get a job or a part-time job just to make up for the debt that you have. Instead, you want to go into retirement with your feet up, really understanding that I've worked all of my life and this is time for me to just relax and rest. So be careful as you enter new debts and ensure that you can pay them off before retirement age. Point number 6, estimate your retirement expense. Knowing how much you'll need to live comfortably in retirement is crucial. This includes housing, healthcare, food, and leisure activities, and much more. Fidelity estimates that the average couple will need about $300,000 for healthcare costs alone for retirement. So you can see here that 300,000 is not an easy amount to just save up. You don't just save that up in a day or two, depending on where you are in your financial situation. So you really do need to plan for this for the future to make sure that you're in the best possible situation to cover yourself if any financial expenses were to come up. Now, a practical advice I'd say is create a detailed budget estimating your monthly expenses in retirement. Don't forget to factor in inflation and unexpected costs, and I'd strongly advise you to go through this with either an accountant or a financial advisor so they can be specific on your financial requirements. So one tip that I found useful while I've been planning for my own retirement is that I don't actually look at the amount I've accumulated on a short-term basis, but instead I view it on a mid-term basis. Now, how you define short-term, mid-term, and long-term is subjective, but I would suggest, as opposed to having an eye on it every day, you may feel very discouraged and you may want to even withdraw money from there. So I advise two things. Number one, only view it on a mid-term basis. And number two, for your retirement, ensure you have it in an investment vehicle where you cannot take out the money from your retirement plan. So if you've got it in a fixed rate ISA, or if you've got in a fixed rate account, then it means that it's locked in there. That is fixed money that you cannot withdraw. So wherever your money is, make sure you can't easily just withdraw it. Point 7, professional advice. Seek professional advice. A financial advisor or an accountant can provide personalized advice tailored to your situation, helping you navigate the complexities of retirement planning. According to the Northwestern Mutual study, 71% of Americans say their financial planning needs improvement, and only 29% work with a financial advisor. Retirement planning is not an easy thing to just wing. It's similar to when you have your own organization and you have a business and you have a business account. You go and reach out to an accountant to help you with your business accounts, unless you understand the accounting principles and bookkeeping. But if not, the chances are you're going to reach out to an accountant for some type of assistance. In the same way, you shouldn't feel like retirement you're able to do all on your own, but instead reach out for assistance. It could actually be something that you're able to do by yourself, but at least understand it and get a professional to give you that green light so that you know you can do it yourself. Seek a professional advisor. So practical advice here is consider consulting a certified financial planner to review your retirement plan. They can help with investment strategies, tax planning, and more. And I actually suggest you do this as early as possible. Even though it may be so far away for you, still do it as early as possible and don't leave it till the last minute. So I actually reached out to a financial advisor and an accountant on 2 separate occasions. Again, I advise you speak to, as long as there's no cost implications to this, if you can have a free consultation, speak to 2 or more financial advisors and speak to 2 or more accountants. Again, as long as there's no cost implications and you can ultimately inquire for free, then definitely do your due diligence and compare what the different financial advisors and accountants are saying. And I also understood, because they were able to highlight to me the different tax advantages that I have with different investment vehicles. Without their help or their guidance, I wouldn't have been able to understand this, and I just didn't know. I wouldn't have known where to look. I wouldn't have known how to start looking, but because they've studied this information, they know what works best. So as I said, don't rely on one financial advisor as the source of truth, but compare different options and different answers you get so that you can formulate the best argument for yourself. Planning for retirement can seem overwhelming, but taking these steps will help you secure your financial future. Start early, take advantage of your employer's benefit, diversify your investments, understand social security or benefits in the UK, manage debt, estimate your expenses for retirement, and seek professional advice from as early as possible. Remember, the key to a successful retirement is consistency, planning, and making informed decisions. Thanks for watching, and if you found this video helpful, please like, comment, and subscribe for more financial personal tips.